Welcome to the Excel Centre. Congratulations if you made it through the DLR. Hopefully it wasn't too bad. So the subject for today is all about the valuation of your business, how you value it, but most importantly, how you increase the value of your business. So what we're trying to do with this session is really equip business owners with how the system works, because I think that's key to understanding what you have to do to get that value up. So we'll take you through the agenda as shown. We're going to talk about the specifics of business values, how they calculate it, what are the things buyers look for, what are the areas that need to be adjusted to get the best for the business when you sell it, and then finally as a worked example to show you how powerful it can be if you make some small steps to improve the business, how you can really improve the value. That's my first half. Atreya, my colleague, will be doing the second half, which is stepping you through the process of selling your business. Again, if you understand how the process works, you're so much better placed to sell the business at the right price. The sale is a negotiation. So if you understand the rules of engagement, then you stand a better chance of making money. Just a little bit about Atreya and I. We're both partners in a firm called CMC. We're relatively unique, if you can be relatively unique, in that we are both business brokers and we are business advisors. So Atreya and I both run businesses. Certainly I've bought and sold businesses over the last 30 years. So I've not only have I seen it from both sides of the fence as a buyer and a seller, but also as I've been a principal. I bought businesses on my own account, but I'm also experienced as an advisor. So I think we've got a pretty good mix of what we do. CMC itself is 30 years apparently, not me, but the business has been around for that length of time, always working with SMEs, helping them build and deliver value for themselves. So to jump straight into the arithmetic, because whatever else you have in the business, there is an equation that will determine how much you get for it. Now, if there are any accountants in the room, they'll be saying, well, I've oversimplified it. And that is absolutely true. But the basic model holds that your business will be valued on the basis of the profits times a multiple. So if you have a business making £200,000 of profit a year, you might get a multiple of between 4 and 5. That means your business is worth 800 to £1 million. Now, that's a simple bit. The complexity comes in to how you actually measure those different elements. So the first one's about profit. So you can measure profit in many ways. The big measure that most people are using, particularly as you get into the 2s, 3 millions and above, will be a concept called EBITDA. So that is profit, but excludes depreciation, excludes tax, and it excludes interest. And that's trying to mimic cash flow. It's quite close to how much cash you will generate in a year. You can, of course, use different measures. And it depends on the company, depends on the buyer. But having those two figures, having those different ideas, EBITDA and then EBIT, which does include depreciation. The next element is this concept called normalization, which is, I saw a guy a couple of weeks ago, and he said, right, I've got this business, and it makes £300,000 of profit. And the bloke down the pub says it was worth 8 times, so I'm here for 2.4 million. If that's right, yes. And of course, I had to disappoint him. What happened was, he makes $300,000 a year, but there's no director's salary because most directors of owner-managed businesses take dividends. So there were 2 directors. You put that back into the equation, then their profits are really only 150. Because that's what it would, a buyer, if they took it on, they would have to replace the departing owners. So normalization, there's lots of nuances around it, but just be aware it's not often quite as clear-cut as you'd hope. The multiple of 8, yes, if you are a high-tech business expanding, growing crazily, you might get a multiple of 8. The reality is if you're a steady business, then your multiples are going to be lower. So it's as well to understand that at the outset. So the profit is relatively pinnable downable. You can, with your accountant's help, have a pretty clear view of the sort of profitability that you make. What's not so clear-cut is this multiple. So the multiple is a number that reflects really two things. It's all about attractiveness. How interesting a business are you? Where do you sit in the market? What's your growth potential? It also reflects risk. And the risk in the business may be you have one major customer who supplies all your business. It might be that the directors, the owners, one or more, maybe they do everything. And I'll come back to this point about owner dependence because it's a really important issue. I've given some numbers there just to give you a sort of a feel. There's always exceptions. I'm occasionally delighted and surprised by selling businesses for higher multiples than that. But the steady multiples, typical averages around the 4, 5, 6 level. Less if you're, it depends on the size, scale matters here a lot. If you're sub $1 million turnover, then a buyer will look very hard at you to try and work out what the business is going to be like without you. Yes, there's goodwill. Yes, you've got regular customers, but they will be really worried about where you, as an individual, sit in the business. And I'll say, well, that's one of the big issues I'll come back to. This is also done on a basis that you've got no debt in the company. So the multiple model says what's called cash and debt-free. So if you have excess cash in the business, then you can take that out. If you have debt, you often have to repair that. So I didn't say, by the way, stop me if you've got any questions, observations, or you think I'm talking rubbish, do challenge, do let me know. But is that equation, is that cool? Yeah? The subtlety is less clear-cut, but the basic model, really that's where it ends up. In almost every deal I've done, there's always been a conversation about that. Oops. Go the right way. So simplifying it again, there are two types of buyer broadly. There's other trade people. And trade buyers are interested in synergies. Much overused word in the world of corporate finance. This is 2 and 2 and getting 1. A sensible buyer will say, okay, I can buy your business. It's in the same market as I am. What I'll be able to do, I'll be able to cut costs. So I will be able to take your telco, add my telco, save some head office costs, save some sales costs, improve my buying. So that's a cost synergy, effectively. You've saved money. And that's a pretty solid synergy for a buyer. And those are people who are basically buying things that are the same business, but they just want more of it. The other type are what I call the vertical integrators, and they will be people like telcos buy a lot of IT companies and vice versa, because they get revenue synergies. That's they can sell different ranges of products to the same customer group. So those are the gold dust. That's when you make the better margins, when they can see how you get those synergies. That's one type. The second type, broadly, are the finance buyers. So they're buying, really, it's all about cash flow. They might be a private individual who's got some money, maybe he sold a business, he's looking for a new project. Maybe it's a finance company who wants to build their portfolio. I sold a wholesale business to a finance buyer, and he effectively paid nothing for the business. It was a very successful sale. It was a 1.3 million sale. Both the buyer and the seller were delighted. The way he did it was borrowing money in the company. He paid on deferred terms. A lot of it was contingent. But that whole mix meant that he bought the company for really not much money. From the seller's point of view, he got a 5 times multiple, which was for him the sort of answer he wanted. He had to hang around for 2 or 3 years. He had some sales targets that he blew out the water. So he made exactly what he wanted. But initially, he thought I was mad when I explained the deal to him. He said, "This guy's buying my business for nothing." Well, yes, that's what's called a leverage buy-in. So there are different types of deals. The trade buyers will often be more transparent, you know what's happening. The finance buyers are a little bit confusing, but really they're very valuable guys if you can get them on board. So let's think now about the multiple and the attractiveness. And again, this is all about risk and reward. One of the big elephants in the room of selling a business is the role of the owner. I sold a telco a couple of years ago, and the guy who ran this was very charismatic. He was a great salesman. He built a lovely little business, and we sold it and we got a great price for it. But we lost a lot of buyers before I managed to rein him back, because what he was doing was, when we went to see a buyer, he told them how great he was, what he could do for them, and what a fabulous chap he was, and how much he knew about telco, which is great when you're talking to a customer. Talking to a buyer is exactly the wrong thing to say, because the buyer said, my God, this business is all about him. And the actuality was really, he was actually slightly overhyping it. He spent a lot of time on the golf course in his villa in Portugal, and I eventually got him trained to say that. And what he was indicating was the business worked without him. And that's really important, because the buyer isn't buying the owner, he's buying the business. And yes, there'll be a handover period, and yes, it's a good or bad business. But fundamentally, they're very worried about the role of the owner, particularly in the sub-1 million, maybe even sub-2 million businesses. So having a strong second tier is really key to that. So you've built some management beneath the top guy. And that really makes buyers excited. And guess what? When we're advising clients, we say, well, the business is, you're knackered. You as an owner can't work any harder. So guess what? You're holding the business back, my friend. I'm not very subtle, so I probably put it in exactly those terms. What they need is another tier of management to spread the load. Now, I understand how hard that is, because you're bringing in professional managers, and that's tricky. But it both allows you to grow the business, but it also allows you the privilege of stepping back a bit. And when a buyer comes along, they say, fine, you disappear off into the wild blue yonder, maybe a year, but you're gone, but I'm inheriting a business. I've got all the moving parts. The other feature on this one is, for me, is about profit and steady profit growth. As we said, we can make it as attractive as you like, but the profit has to work. So driving that profit step by step, year after year. I'm with a client at the moment who has a lovely design business. He is a world leader in what he does. And his profits have been growing nicely, 100, 150, 200, 250. I thought, wow, this is fabulous. He's just finished finalizing his year, and guess what? His profits have dropped. A few contracts slipped. The recruitment didn't work out. For a broker, that is a nightmare, because despite all the goodwill he's built up over all these years, the buyers hone in on, well, your last year was a bit iffy. That equals risk. That equals low value. So it's hard news, because he's built this business over 20 years. Why should it be affected by 1 year? Well, I'm afraid, guess what it is. So on the good side, it's about building a team, recurring revenue, because it's lower risk. Proper processes, an idea that you're running the business properly. If it all revolves around the owner, he might not have processes, because he just shouts at people and he knows everything. He's a better salesman than his sales guy. He's a better operations guy than his operations manager. But if you've got those people and processes in place, then you stand a good chance. So very much a case of managing those, and planning for an exit is again, one message I'd please take out from this. Don't wake up tomorrow and say, right, now's the time to sell. Wrong answer. Give yourself a couple of years to hone the business to be the best it can be. A lot of guys, particularly if they're as old as me, are a bit, I've done this for 20 years, enough already. I want to go now. And we can certainly do that, but taking a couple of years to fix, most of those things are fixable. So giving yourself time to fix them, I would really urge you to think very hard about, so you can get that get that value from the business. If I was a better sales presenter, I'd be saying, triple the value of your business. 6 easy steps. Too late, too old to try and to get to that sort of degree of marketing oomph. But that's what this model is trying to show, the leverage effect of getting it right. So let me set the scene. This is a 2-director company, turning over a couple of million, flatlining along. The business is good. The kids are educated. There's a Range Rover in the drive. They've got their apartment in Portugal. So it's a good business. They've really done well. What's not to like? They then come to sell the business, and actually it's a slightly different story because they've got a profit of 200k. Well, if I apply some adjustments to get the salary right, then actually it's only 100k, and it's flatlining. Nothing much is happening. No second tier. So the multiple you'll achieve will only be 3, maybe 4, maybe more, maybe less. But that's what delivers that 350k value. And a lot of business owners, those circumstances, say, why would I bother? And I'd have to say, yes, why would you bother? Just stay with it. So what happens if you make some tweaks? What happens if you say, well, let's just work that profit number. Let's get it up from 200 to 250. Let's get a bit of growth going. Not a lot, just a bit. And then suddenly your adjusted profit goes up by 50k. Well, doesn't sound difficult. Well, I'm sure it is in some cases. But you've actually increased your profit by 50%. So think back to the equation. You've moved one side of the equation by a whole 50%. You've also made the business more attractive. So your multiple is now 4. So I'm not trivializing how hard it is to drive a business to that next level, but you've already doubled pretty much the value of the business. Let's take the final option, which is, okay, you really decide you're going to go for this. You take your 2 million turnover up to 2.5 million. You improve the margins a bit. You put in place a second-tier management, and you've got a business that has profits of over 200,000. So you've doubled them. But more importantly, you've made it look like you've improved the attractiveness. So your multiple goes up. So your multiple goes up to 5. And therefore you're sitting over £1 million of value. So as advisors, we know shifting a business like that isn't trivial, but it's worth a go. And that's the prize, that you triple the value of the business. So I think we spend a lot of time encouraging customers to realize that those couple of years when, okay, you maybe have had enough, but think how much you earn in those couple of years if you get that right. So it's not for fun. Your time is precious. You've got other things to do with your life, but driving the business to that next level means you markedly increase the value of your business. So what really matters in getting that value up? Well, there's no getting away. It's all about profits. That's the big one. And those are true profits, adjusted profits, normalized profits, however you want to call it. But that's what people are buying. They're buying future cash flow. They want to see the profits right. Preparation is all about the stuff we talked about, is fixing a lot of those niggles in the business, about maximizing profit, about encouraging a second tier, about having management accounts that make sense, not just to you, not just the accountant. So you've got a business that is whole and sustainable, because a buyer says, right, I get that business. I can see the management accounts, I can see the team, I can see the organizational structure, I understand you've got the contracts in place, blah, 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 blah. Whole shed load of stuff that really does help the sale process, big time. And then my third point is about people, that as an owner, you've got to do a few unintuitive things. Stepping back is a good idea. Pulling yourself away from the day-to-day, so that when a business is sold, it can live without you. It's about building your team. So you're selling, you don't have to just sell yourself when you tip up for a meeting. You say, well, I've got the team, I play a bit of golf, I don't go on Fridays. Counterintuitively, buyers like to hear that. So you've got a great team, you're leading, you're the conductor of the orchestra, you're not playing every bloody instrument. That's another common metaphor to get you really to get to the idea that stepping back is a great thing to do. And the smaller the business, the more important that is. Okay, well, I'm going to hand over now to Atreya, who's going to talk about the various stages in the process of sale. And that's important because it's a negotiation. So yes, there's a preparation point, but all the issues of due diligence are really very worthwhile to understand how that works, because you get a better outcome. You don't do it for fun. You've got advisors, you've got people supporting you, but if you understand the process, then you're much better at managing and delivering the value. Okay, Atreya. We'll be back for questions at the end. I don't think I said that, did I? No. But yeah, please catch us when at the end of all this, either in session, ask questions, or we'll be around for as long as it takes if you've got specifics. I understand this is quite a confidential thing for people thinking of doing this. Anyway.
Thanks, Simon. Don't go. Right. Okay. Let me start with two statistics, which I hope will set the context of what we're going to talk about in the next 10-15 minutes. So consider the fact that there are various studies, academic, industrial, analysts, but broadly most of these studies converge on the fact that anywhere between 60 to 80% of business sale transactions do not deliver the value that Simon was talking about earlier. Just keep that statistic in mind, and feel free to Google this. It's a fairly well-established fact. And the second statistic is, as business owners of private businesses, as opposed to public listed companies, so most of the definition of private business, of course, is that you do not have public shareholders. So private businesses invariably sell at a discount of about 25 to 30%. So going back to the equation of your normalized profit multiplied by a multiple equal to the sale price, you divide that sale price by the discount factor, which essentially lowers the sale price. That factor is usually 25 to 30%. So the question then becomes, why is that the case? And what can this community of business owners, advisors, accountants, financial consultants, everybody involved in sale of private businesses, what can we collectively as a community do to increase the value of the business? That is called the intrinsic value of the business. So that's really what I'm going to talk about. How do we ensure that through a structured process, we can maximize the value of this business that Simon was talking about, that's possible for the buyer to pay and for the owner to realize. So this is a 6-step process. This is not cast in stone. There are various sub-elements to these processes. It's also not linear. It's not a sequential process all the time. You have to kind of go back and fix things when you're on step 3, if step 2 is not fully done. But for the purpose of simplicity, these broadly are the major categories of steps. So Simon spoke about preparation, and between preparation and post-sale is all the elements of risk that we were speaking about earlier. And this managing this process is perhaps fundamentally the only thing that the business owner and the advisors involved in the transaction need to be concerned about to maximize the value and minimize the discount that private companies invariably suffer from. And hopefully at the end of this presentation, as to why there is a discount element, why do you pay less for private businesses than they are intrinsically worth, hopefully that question becomes a little bit clearer to answer as we go along these steps. So preparation is all about packaging the business. There are unsavory terms like grooming the business. Unfortunately, that's an industry term. But it's all about ensuring that when you present your business, the other side, the other parties who are interested in analyzing your business as prospective buyers, truly understand what is it that they're buying. So that preparation step is vital. It's a critical determinant of success. Marketing is all about publicizing, so events and other mechanisms are a way by which you put your brand out there. It's no different when you have to sell your company. You have to solicit proposals, and that's all about marketing. Agreeing the deal is the initial form of coming to some form of a negotiated agreement. It's a much protracted story about how you negotiate a deal, but you have to put some terms which are the starting elements of a negotiation. So typically a set of term sheets that outline the condition, the structure. So we'll go through a little bit more in detail about that. DD, due diligence. Some of you from experience of doing these deals will understand and appreciate how fundamental this process is. It's also one of the most effort-intensive processes, which impacts the business owner, the advisors, the buyer parties, everybody involved is quite strongly focused on the DD process. Contracting is legal, it's procedural. You have to go through mandatory steps depending upon UK law. There are employee regulations that one has to be concerned about, etc. So all those are packaged within the process of contracting. And then finally, post-sale, the deal is not done once the deal is done, believe it or not, because especially in private company sales, there is the whole element of earn-out and of course integration. So we'll talk a little bit more about that in detail. So to Simon's point, if you wake up as a business owner one morning and you realize that you've had enough, guess what? You will have to get up at least for another 1,000 days with the same feeling, because that's pretty much how long it will take, however good your business is, before you are able to reach a stage where you're able to realize its full business potential, which means that there is a significant amount of preparation involved before prospective buyers reach a stage of visualizing the business. So I've been in this business for over 2 decades now, and my expertise broadly spans between corporate M&A and corporate strategy, because both these elements go very closely together. And one of the things that I have consistently found, irrespective of the geography, the size of the business, or the sector in which a transaction is being planned and executed, the business owner always, I have not come across a single instance when this is untrue, does not understand why the buyer on the other side doesn't realize how good and sexy the business is. And the fact of the matter is, you like your house, you like your car, you like your kids much better than somebody else. And that's just organic, it's biological. You have put all your blood and sweat into your business, and you appreciate the pains that you have taken to get the business this far, that the person on the other side of the line simply does not appreciate. So if you want to get the maximum value from what you're trying to sell, the onus is on you as a business owner and on the advisors who are helping the business owners to maximize the visibility of that value. And that's why this duration, this time that you look at here is actually a very practical consideration. So it does take a lot of time to be able to reach a stage where you can sell your business. So preparation is all about, as I said, identifying those elements that the buyer will be looking for that ensure that the risks perceived by the buyer are minimized. So there is a business that I was involved in recently, and it's a software services business. So basically a company that does software implementations and technology services. It's a two-owner business. They've been running it for about 22 years now. Quite a well-established business in that part of the market. And fundamentally, we realized that almost 85% of their revenue, which has been steadily growing at about 5 to 7% above inflation, above market rates. So it's a business that's been growing at about 12 to 13% every year for the last 10 years, is fundamentally derived from 2 customers, both of whom have developed long-term relationships with the founder CEO. So imagine what happens if you are a prospective buyer and you say, okay, this is a business that's steadily growing, it's been generating a CAGR of 10%, But suddenly, at the end of the transaction, if the business owner leaves the business, which is the expectation anyway, what happens to these customers? What happens to my revenue? What happens to my growth? So preparation is all about identifying these risk elements and figuring out an appropriate mitigation plan that says, how do I get rid of this risk, or how do I mitigate this risk? And that's where the time comes. So what we essentially did to fix that problem was to prevent what's known as customer concentration risk, right? So it's all about saying the revenue and the growth of that revenue does not come from one or two customers. It comes from a diversified set of customers, so that at the end of 5 years, for example, if one or two of those customers leave the business doesn't just tank, right? So there are other customers who can continue to provide that revenue growth. So that's one example. Another example that's invariably super effort intensive as part of the preparation process is profitability. And of course, we've seen from the earlier equations that profitability is directly impacting the value of the business. Getting profitability up in a short period of time is unfortunately not as easy as it sounds. We've all seen lots of media reports about how companies improve profitability. You basically reduce costs. You reduce costs by reducing, for example, human workforce. If you fire people, the operating expense comes down. Where do you spend a lot of money? Marketing and sales. Reduce your advertising and marketing expenses, your operating profit should normally go up, all things being equal. Overheads. How much do you spend in overheads, maintaining your facilities and back office operations? Reduce those costs, your OPEX can go down. All of these elements are exactly what you would anticipate needing to do when you're preparing the business to increase the profitability. But here's the challenge. Let's say you want to fire people. What happens? A prospective buyer is not buying your business because you fired people and improved the operating margin. The prospective buyer is buying the business because he wants to buy the people in the business. He wants to buy the technology in the business. He or she wants to buy the assets in the business. So the way you prepare the business to improve the profitability has to be done with regards to the buyer's perspective, and that's super critical. So this is all about understanding what are the motivations of the buyer on the other side of the line with whom you are attempting to negotiate and identify the value of the business, and basically say, what's right for me to do the business, what's right thing for me to do in the business that I have not managed to effectively do in the last 5 to 10 years, right? So, and that strategizing process, and more importantly, the execution of that strategy is what takes time and effort. Tax planning is another important element. So Simon mentioned highly leveraged buyouts, and of course when you sell a business, depending upon the structure of the business, and we don't have to go into the details because it's a fairly protracted conversation, but the impact of the tax to the buyer as well as to the seller is a critical determinant, and that requires a certain element of financial diligence, if you may. And finally, preparing a team as part of the whole preparation process, which is who are those individuals from the organization that's being put up for sale, which invariably involves the business owner, the managing director of the company, perhaps the top shareholders of the company, along with the advisors. The impact of creating a team like that, both on their time as well as their management bandwidth, that's another important element of preparation. So once you have prepared, and I'm kind of fast forwarding this whole process because in practice, in that timeline that we saw, I have seen preparation times anywhere between 6 months to 18 months, actually 24 months, depending upon the complexity of the business or the initial baseline stage that the business is in. But assuming that you have gone through identifying all those operational as well as strategic drivers that we spoke about around revenue, customer concentration, cost management, tax planning, identifying your steady revenue growth rates that you want to achieve. You have identified all those elements that add to the perception of the value of the business. You now need to be able to go out there in the market and essentially publicize this opportunity. So that's all about soliciting and making inquiries for prospective buyers. There are various ways of doing this, some which are a little bit more public, some which are under the wraps. There is a strong element of confidentiality involved in this because, for example, what you don't want to do is to basically publicize the business in such a way that your customers get scared that you're selling the business. And what happens to the customer's perception if you're selling the business? They are concerned whether you can support the products and services that they're buying from you, right? So there is an element of business continuity risk that has to be managed, and hence there's an element of confidentiality. So marketing is usually done by preparing certain information that becomes available to prospective buyers. This information is exchanged as a result of signing certain NDAs, non-disclosure agreements, and the NDAs essentially provide a mechanism by which you can, for example, receive what's usually known as an IM or an information memorandum. So information memorandum is a formal structured document that identifies the nature of the business, gives details about the people in the business, the history, experience, and the background of the owners, how they have brought the business to the state that it currently is in. It talks about the historical revenue financial profile. It talks about the pipeline. It talks about the margin profile. It talks about the competitors in the business, et cetera, et cetera. So everything that you would like to know as a prospective buyer about the business is documented. And that usually becomes a formal document through which the buyer, the recipient of the IM, begins to evaluate the business and hence the interest in that business. Once you have marketed the business, usually what ends up happening is, let's say argumentatively and hypothetically, you send out the information memorandum to about 50 prospective buyers. 50 prospective buyers invariably whittle down to maybe 10 of them who have demonstrated some credible interest in this business. You sit down with those 10 prospective buyers who have evinced some level of interest in what you're trying to market, and from them you essentially get what are known as non-indicative LOIs. These are letters of intent that essentially say, hey, I saw your information memorandum, I understand what you're trying to sell, let's have a conversation, can I get a little bit more details on a few things that your IM is not clear? You engage with them, and as a result of those conversations, they feel comfortable and confident enough to basically put a price on the business, right? So they essentially make an offer. Now, this offer can be formal, or it can be a formal but a non-binding offer, and hence an indicative letter of intent. And in the letter of intent, you essentially find a couple of things. You will find things like, what is the buyer willing to pay for the business? Of course, that's the dollar value. But you also tend to find things such as, in what format will that be paid? Private company deals are always cash buys, invariably, which means that you don't necessarily buy part cash and part shares, because the buying party is also invariably a private company. There are cash plus share deals that are quite possible. So for example, if you're selling your business to a public listed company, if you're lucky enough to sell it to a public listed company, you could probably get a combination of cash and shares, which is the company says, hey, I'm a public listed company, I'll pay 50% of the total agreed price in shares that I own, so I'll give you shares of my company, and the remaining 50 in cash. So that's an element of how you want to structure the deal. And also in the offer letter, you will find, and again, this is very, it's almost an exclusively private company sale arrangement, and that's all to do with earnouts. So earnouts is an element of risk mitigation by which a buyer who's buying a private business, your business as a business owner, wants to ensure that everything that you are saying and promising actually gets delivered once there is a change of control. So which means that if you have promised as part of your information memorandum that my company is going to grow by 10% for the next 3 years, the buyer expects you to be part of that business and ensure that some element of that growth is delivered. If you go ahead and promise that my business delivers a 30% EBITDA margin, and this is the level of profitability that's normalized, and I should expect, perhaps an element of the earnout is to ensure that you do actually deliver 35% EBITDA. It could be the other way around as well, which is, let's say there is a slightly underperforming business. The earnout could have an element which says, okay, I understand that your business is only generating 10% margin, EBIT, EBITDA, net income, any measure of operating margins that you want to look at, but help me get it up to 15%. So basically deliver another 5 percentage points of margin, and in return for that increase from 10 to 15, I will pay you another 500K on top of the 2 million pounds that we agree. So that's basically a contingent earnout scheme where you get additional money as a seller in return for improving the business performance. So as a result of an indicative LOI or a term sheet that you broadly agree, a buyer will always insist on a due diligence. And a due diligence, in a very simplistic term, is essentially going under the wraps of the company. I want to understand exactly what the company is. I look at the books of the company, so audited and unaudited financial statements. I want to have deep conversations with the business owner. Sometimes, and there are both challenges and opportunities behind it, but a lot of times buyers want to understand if they can get access to the customers of the company that you're buying. Can I speak to your suppliers so that I understand how you actually manage your suppliers? Can I talk to your senior management team, which of course is invariably done if there is a senior management team. So due diligence is all about saying, here's what you're showing me on paper. Can I now get physical corroborated evidence of exactly what is it that you're saying so that I increase my level of confidence in what I'm buying? And I think practically speaking, due diligence is, as I was saying earlier, one of the most effort-intensive elements in the process of buying the company. There is an enormous amount of time and management bandwidth impact on both sides of the party. So the buyers put a lot of time in articulating the questions that they want addressed and answered, and the sellers have to be prepared. The business owners, the shareholders, the co-founders, the team that is selling the business has to be committed to putting in the time to be able to answer the questions that the buyer is asking for, and to be able to do so in a convincing way and in a way that actually corroborates whatever is it that you have actually told them in the information memorandum. So due diligence is a super critical process. There are numerous instances where companies have invested. This transaction that I was involved in about 14 months ago now, we spent about 8 months of time in the preparation phase. We finally moved from an indicative, non-binding indicative LOI to a formal agreement. So, and I'll talk about the contracting process in just a bit. But there was this element around litigation that came out. So basically, the employee of this company that we were looking to buy had sued the company for wrongful dismissal, and that litigation exposure was big enough for us to walk away from the deal. So a due diligence process allows both the parties to explore all the elements that are otherwise not possible to be explored prior to change of control, right? So you can imagine why this is such an important element. So once the due diligence has been completed satisfactorily for both the parties, so essentially the seller feels that they have answered all the questions, the buyer feels they have received satisfactory answers, the letter of intent or the original term sheet then moves into a legally contracted process, which means that it becomes a binding process. There are various flavors for what goes into the contracting process. It could be a share purchase agreement. So if there is a full share control or shares are being sold, you typically have a shareholders agreement that ends up being transformed into a share purchase agreement. If you are not buying the shares of the company, but you're buying certain pieces, so if it's an asset buyout, then you typically have an asset purchase agreement or an APA. But whatever is the flavor of the negotiation, a formal purchase agreement, just like a house sale, analogously, is basically to say, here's what I'm selling and here's what you're buying. There are usually a lot of legal representations. Representations are nothing but me as a seller saying, I am vouching for the fact that I have 10 customers, and these 10 customers are giving me 100K of revenue each, and hence £1 million of revenue from these 10 customers. I have master service agreements against all these 10 customers that is allowing me to sell. I have a registered company with this address. I have filed my audited tax returns, and these are the outcomes for the last 3 returns. So a set of disclosures that form the legal basis for the buyer saying, yeah, okay, I understand what is it that I'm buying, and you are primarily vouching for what is it that I'm buying. So again, there are various nuances to this, but one of the critical elements, especially from UK law perspective, is the to pay. So that's the employees, that's the transfer of undertaking employees protection law, so which essentially secures the employment of employees whose owner is being transferred from the current to the new. So it protects employee rights. So these are the things that the buyer has to be aware of, because these are contracted, these are legal, these are binding. And of course, as part of the final agreement process, the earnouts that we spoke about, the deferred compensation elements that we spoke about, all those things are now set in stone. So, and what that essentially means is that once the contract process has been concluded, both the parties have signed and agreed and shook hands and exchanged documents. If there are these contingent payments, if there are earnouts, the seller of the organization, the primary shareholder, the business owner, the parties who are involved in the earnouts are now contractually obligated to deliver those earnouts. Of course, if you don't deliver the earnouts, it could result in various penalties, including you not being able to, for example, get the upside element that we spoke about, right? So, post-sale. Post-sale is a big topic. We are going to speak a little bit more about this in a session that, again, unfortunately, Simon and I are doing again at 2 o'clock, which has a different flavor, which is on the buy side of the whole process. But post-sale, from the purpose of this conversation, is all about what do you as a business owner need to be aware of, that you need to manage, and that you need to execute once the deal has been done. So we've put a couple of items in here. Again, it can be a much more elongated list, but the actual process after concluding the legal agreements can take anywhere between a couple of days to perhaps 6 months, maybe even a year. And that's all about integrating the company. It's about bringing both the buyers and the seller organizations together so that the buying organization can fully assimilate the sold organization. And that's a legal process. It's a contractual process. A lot of documentation has to be evolved. Customer contracts have to be changed, etc. The whole deferred compensation piece is very critical for the owner at this stage. So being involved in the business, especially to ensure that the business owner is delivering the promises that have been made, those are vital for the success of the deal. And then finally, personal elements such as, I've suddenly now completed this transaction. I have been given £1 million in cash, and I'm expecting another £500,000 in cash at the end of the first year, and another £500,000 in cash after that at the end of the second year as a result of my earn-out compensation. what am I going to do with this £2 million? What's the tax impact of the cash that I have received? How do I manage my capital gains tax impact? So these are critical elements that your advisors can help you understand, plan for, and mitigate so that the post-sale process is as smooth as possible. And then finally, figure out where your boat is going to sail, which island you're going to buy, and where you're going to retire, whether it's in Portuguese, as Simon likes, or the Bahamas. That's really completely up to you. So, Simon, for conclusions?
Okay, guys. Well, selling a business is very personal. So, equipping yourself with the mechanics is just super important. You can sell a business from a standing start, or you can take longer. We think taking a little bit longer is a good idea, but it's really down to you. A bit of long-term planning in any situation you shouldn't vote against. You're not going with a sale. Keep that in mind. Think about, even if you're setting off on a journey, saying if your intention of selling for 10 years, just give yourself the luxury every year to think, what's this business really like? Stand back. What's it worth? Think as a buyer would. Even if you're not going to sell, trust me, this is a really good discipline because you look at the business in a much tougher way. Look, there's a sales plug. Final point. Get some help. You don't sell a business every day. Hopefully it will be CMC, but get help early so they can help you through this planning process. You've deserved it. You've built a business. You deserve to get the best price, deliver the best value. Yes, the question is how does a discount work for a small company? I tend to go to multiples because I'm a simple soul. You can do it discounts backwards, but there are sort of various stages points. Sub $1 million, then your multiples will be looked at very hard because it's obviously very dependent on you and you're risky. You then get into the range, probably turnover-wise, of 1 to 5, when your multiples really can rise quite rapidly. Now, the thing that cuts across that is if you're a tech startup and you're acquiring crazy amounts of business, then multiples go out the window. I don't know what Facebook's multiple is, but it's probably, even now, 20. When it was floated, it would have been 1,000, because they probably weren't making any money at all. So, but size does matter because of the risk that goes with it. That's the important point. So I haven't answered the question about discount, but if you get a discount, 3 might be a multiple for a small company that's owner dependent. 5 might be the multiple for a decent $1.5 million, nicely diverse business, if that answers the question. I think the important thing with staff is quality, if you like. If you've got a management capability that can pick the business up after you go. Some businesses are just by definition very intensive in terms of people, so it's not such a good guide. Turnover's not a great guide, I'd have to say. But if you've got a team of 10 people and you've got a couple of managers in there, that's a much better proposition than... I've got a client who I've been working with for years. He runs the business. He's got 15 guys. I've told him, I'm never going to sell this, buddy, because when you go, there's no one left to run the thing. But I've been with him for 10 years. It is 10 years. Helping him build that business. It's been growing, and he's been automating, and he's been delivering a business other ways. Like every year I remind him, when you want to exit, this is going to be tough, because it's you and nobody else. Oh, sorry, it's got a great team, but nobody running it. Okay, so the question was, what sales don't work? Thank you for allowing me to share my failures in public. Companies who change in the middle, because I'm a very pragmatic broker, so if they come and say, well, I broke down the pub so I can get 8 times a multiple on this, I say, no, they can't, and a lot of brokers won't. So that'd be quite so straightforward. I will tend to, but what happens, the owner takes a big sigh of relief. He goes, oh, thank God I'm selling the business. And the business goes, donk. It's been doing that, and it does that, donk. So they're difficult. Construction's difficult at the moment, for instance, because it's all about one-off contracts. You've got great reputation, you've got great people, but you're only as good as your next big contract. If you've got expertise, that's okay. To answer the question about costs, well, I don't normally cover that on the first date, but let me give you some indicative sort of numbers. Everybody's different. We tend to charge a few K up front to get the business going, to get the process going. So that covers the IM. So we're into sale mode here. So for the IM, a few K, and it might be 2, it might be 7, but it's somewhere in that range. Sometimes people take a retainer, sometimes not, a few hundred a month maybe. But brokers all make their money at the end when they sell the business or not. Percentages range from, goodness, what am I saying here? 2 or 3 if it's a really big, nice, easy business. 3.5 is a very common rate. 5% for perhaps a sub-1 million business. So it's a whole range, and it depends. And brokers will give you 900 different answers on the same thing. That's what we charge. For the way we support people through that process, what doesn't happen is I don't come in and have a look at your business and say, actually, here's my slide deck of the 90 things you've got to do to make this better, and I'll come back when you've done it. Because guess what? That isn't going to work. Our approach is very much ongoing monthly sessions. You've got lots of things to do to run your business, but you have to fix a few of the big things, and that's why it takes a couple of years. I'd love to give you a slide deck. I can give you a consultant's report and you put it straight in the bin. The model is we have to work with the team, with you and your team, to just provide that extra degree of accuracy. So that typically is a few hundred a month. The question is, can you take a percentage of the business on an ongoing basis? If you're selling a percentage of the business, bloody difficult, because most people want the whole business. So if you want to sell a slice, that tends to come down to personal contacts. Anyway, thanks very much for listening, and good luck with your business. Thank you.